Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, we are looking at 4 different dividend growth stocks. What I mean by that is companies that have increased their dividends for a very long time. These companies are not only just dividend aristocrats and whatever, they actually increase their basically dividends, and right now they are basically trading at a discount. They are very cheap companies right now. So let me just quickly show you, right? So before we talk about these companies, and I just want to show you why I absolutely love dividends, okay? And this is not the companies that we're going to talk about today, some of them anyway. But I just want to show you how important the dividends are, right? Look, Lowe's, for example, it increased their dividend by 31%, and they have been paying or increasing these dividends for 60 years. Okay, 60 years of annual payout growth. That is huge. They've grown it from 80 cents per share to right now $1.05. Okay, it's important. Why? Because that I haven't done anything. I bought these stocks. I have it in my portfolio. They've increased it. Okay, that is extra 25 cents that I actually didn't have to work for. And it's really important. I genuinely think this is one of the most important things, because someone is paying you without going to work. Can you imagine? We have to clock in every day, 9 to 5 every single day to get raises, whatever. And because of COVID, some companies have said, oh, we're not going to increase this. But these companies are doing it. Okay. Right. Let me show you basically another company that have hiked their dividends. That's Medtronics. Almost 8%, reaching 44th consecutive years of payout ratios. Again, not a lot, but it is important. 8%. Okay, let me show you the final company, which I actually didn't even know has done this, but they have apparently. On the 12th of May, Union Pacific actually gave us extra 10%. Okay, double-digit increase in the past 12 months only. Okay, so it's really important when I talk about these things, and the reason these companies are able to do that is because they have the free cash flow. They're not just giving you because they feel like it. Okay, they got the money in the bank. They don't know what to do with it. They want to increase that dividend so they can keep their stakeholder, basically shareholders, happy. Okay, and that is the reason why I absolutely love dividends. Okay. Right, let's have a look at the companies that we're talking about in today's video. And the first one is Medtronics. We've just seen it. They've increased their dividends almost 8%. This company does their medical devices. I have it in my portfolio. They're currently trading $99 per share. They released their earnings a couple of days ago, and for that reason the stock actually went down quite a bit, which gave me more opportunities, and I was basically to add to my portfolio, so to add to my position already. So I'll show you that in a second. And when you look at this stock in general, it's like the year to date is actually down quite a bit. Just last 5 days is down 4% because of the earnings report, but a year to date is about 6%. So they're not actually bad at all. Okay, in comparison to the tech companies where they're down almost to 20-30%, this is more of a slow grower. This is like a steady Eddie kind of situation going on here. So it's actually in a good company. EPS $3.65, a market cap of $140 billion, economic moat of wide, standard capital allocation, and their beta is actually quite low. We've just seen it, how volatile markets can be, but they're not really that volatile, which is quite nice. What you miss out when you got a low volatile stock is when the stocks are going up 20-30%. They're not doing that. They'll probably go about 10% if max. Okay, but obviously on the downside, they will not go down as much as either. PE seems quite high at the moment, in comparison to the sector. Okay, but price to free cash flow is almost similar to what the sector is doing right now. Dividend yield of 2.43%, 5-year growth rate of 9%, dividend growth rate is 44 years. Okay, payout ratio only 44%, and dividend safety is 100%, more 99%. That's the highest you can get, and they have $5.67 billion in the bank to pay you. So when companies have free cash flow, the free cash flow, they can use it for all sorts of things. Okay, things like, for example, paying down debt. They can pay you as a dividend, increase the dividends if they want to, acquire other companies, use it for research and developments, all of these things. Profit margin is 15. Okay, 15.5. Operating margins is 21.7. Return on equity almost 10%. Revenue year-on-year growth about almost 14%. Revenue in the last 3 years not great, but 1.32. Total returns in the last 10 years you're looking at about 13%. Current ratio about way above 1, which it means that company is in a very good position. Okay, next 5 years, the company is expected to grow their earnings about 12%. Simply Wall Street says is undervalued at the moment, about 26%. Fair valued is above, according to them, is $133 per share. As we've seen, is right now $99 per share. Morningstar is saying it's about 21% discount. Fair value $129. Tip ranks is more or less the same, but they're saying it's $118 per share by the end of the year, and they are saying it's a moderate buy. In my opinion, it's a strong buy. If you own it already, start nibbling. If you don't own it, maybe it's a good time to look at it. Again, I'm not a financial advisor, but that's what I'm doing. In fact, I will show you right now. That's exactly what I did yesterday. So the money I showed you in the last video, okay, that I actually sold a bit of Pfizer because of the growth in the next couple of years and the fact that the stock is actually, I feel like, it's overvalued right now. I sold that and I bought 7 shares of Medtronics. Okay, 7 shares of Medtronics at $38 per share, and it's right now about $39 per share. And as you can see here, okay, I own 20 shares of that company right now. So just to be transparent, okay. Right, the next company we're looking at is Lowe's. Lowe's is another company that we just saw hiked their dividends, currently trading. They are in the home improvement retail sector, okay, currently trading $199 per share. That's probably the lowest I've seen in ages. EPS 12 and 31, market cap $120 billion. They are absolutely brilliant company when it comes. They have economic mode, their capital allocation is absolutely brilliant, and their beta is quite low. PE 16, price to free cash flow almost a 16, okay, and that is really low in comparison to the sector. So the consumer cyclicals are right now trading about 22, but this company is actually, this tells me is very cheap right now. Dividend yield of 1.73. Hopefully, because they're increasing it a lot, that will keep going up in the next few years. 5-year growth rate of 18%. Dividend growth streak of almost, well, now it's 60 years in a row. Payout ratio 24, and dividend safety 93. 99 is the highest. That's absolutely fine. Free cash flow of $8.26 billion in the bank, which is really nice. Profit margin about 9%, on operating margins about 13%. Return on equity, couldn't find it. Revenue year on year 1.21. In the last 3 years, they've increased basically the compounding growth rate of 10%, revenue growth of 10%, total returns 20 to almost 22% in the last 10 years, which is basically why a lot of people say this is more of if you look at the retail sector, the home improvement sector, this is more of like a growth stock if you think about it. Okay, current ratio 1.17, which is basically higher than 1, which is what we would need. Next 5 years, they expected the earnings to grow by 15%. So this is Yahoo Finance. Simply Wall Street valuations is almost 40% undervalued at the moment. Their price target is $330 per share. Morningstar is saying fairly valued. 209 is their fair value price. Tip ranks about 18.5, and their 12-month price target is $237, and they are saying strong buy. For me, is definitely, I do agree, it's a strong buy for me. I will be adding to this company as time goes by, and if it stays around these areas. The next one is a company that I do not own, Williams-Sonoma. This company is actually, I've looked at it recently, and then they had their earnings report. Everybody in the retail sector was actually negative. They came out and they were like, nope, we're fine, everything is perfect. Okay, they own the brands like Pottery Band and so on. I think they own also, West Elms and so on. They came out and they said, yeah, everything is fine. I think the stock went up like 10% or something like that. They currently trading $130 per share. EPS is 15. Market cap of just 7.5. So this is not a huge company. And when it comes to economic mode capital allocation, they narrow and standard at the moment. Little bit volatile, okay, in comparison to the rest of the sector. PE just 8.5, and price to free cash flow just 7.21. Dividend yield of almost to 3%. 5-year growth rate 12%. dividend growth streaks of 15 years in a row, payout ratio 17, dividend safety 80%, which is quite good, and $1.1446 billion in the bank. Basically, relative to this market cap, is actually, that's quite good. Okay, profit margins about 14%, operating margins almost 18%, return on equity 68%, revenue year on year 21, revenue 3 years, okay, really good. Total returns in the last 10 years, absolutely brilliant for this type of company. Current ratio above 1, which is good. Next 5 years, the growth is just gonna probably slow down a little bit, so about 4.3% every year in the next 5 years, according to Yahoo Finance. Simply Wall Street is saying that actually the price of this company should be about 340, and that is 61%, or almost 62% undervalued at the moment. Okay, then Morningstar, almost a 50% undervalued, $227 per share, and this is after the earnings came out. They've actually adjusted that. Tip ranks more or less slightly lower, okay, but there's the price. Their price target is 153. That gives you about 16-17% upside there, and they are saying it's a hold at the moment. Really good company, very small, very good company. It's cyclical, so I've already got a couple of those companies in there, so I'm a little bit worried about that beta and so on, but it's a really good company when you look at the profit margins. Again, none of these things, by the way, I mean, the company is going to do the same thing in the next 5 to 10 years, okay? You just have to be careful with that. But obviously, it gives us an idea of how profitable this business is, okay? And the final company that we're looking at is UPS. It's a company that I own in my portfolio. It's in the industrial sector, okay? Currently trading $182 per share. The stock went down quite a bit with the market, so it kind of gave me an opportunity to buy a few shares, and I'll show you that in a second. EPS 12 and 26. Market cap of $151 billion, and when it comes to economic mode and capital allocation, is absolutely perfect. Beta really low, PE very low, and price to free cash flow very low in comparison to the industrial sector, okay, 21, and you're looking at about 15 and 14, which is really cheap, okay, if you think about it in terms of PE wise. Dividend yield, obviously there are other things that you need to take into consideration, but from PE perspective and price to free cash flow, that's really nice. Dividend almost 3.5%. Wow. 5-year growth rate of 6%. Okay, dividend growth streaks of 23 years. Okay, paying that dividends just non-stop. Payout ratio of 37, and dividend safety about just 70%. Free cash flow about $11 billion. So there's no issues paying that dividends in the next few years. Profit margin is good, operating margin is good, return on equity is absolutely brilliant. Revenue year on year percentage wise is 10%. In the last 3 years, compound growth rate is about 11. Total returns of the last 10 years about almost 11 as well. Current ratio way above 1, which is nice to see. So they are really doing good, okay? They are doing good job. They've got good cash flow there. They're paying really good dividends, and they seem to be cheap at the moment. So let's have a look at what the analysts are expecting. So the next 5 years, basically expecting 14% growth year on year. That's really nice, okay? So every single year. Simply Wall Street is saying it's about 24% undervalued at the moment, $241 per share. That's the expected price. They're thinking about that right now. That's where they should be. Okay, Morningstar more or less the same, but $886 per share. But they are saying it's fairly valued at the moment. Tip ranks 23% upside, and 241 is their price. Look at that. Those two are very similar. In fact, that's exactly the same. That's very strange. And according to tip rank, it's a moderate buy at the moment. Right, apologies, that wasn't right. So that value 241 is for Simply Wall Street, and tip ranks is 224.56 pence. Okay, so that is the 4 companies I want to share with you guys. The reason I'm doing this, to be honest with you, is kind of bring your attention to companies that are really good. Okay, they have good financials, and right now might be basically on discount. And this is what we need to do as investors. Don't wait until the markets are going up and then start buying. Buy when the stocks are down, Okay, so when there's a bit of an upside, then you actually have the opportunity to add to those whatever, right? And then you can just sit back and relax. I've got 8.6 shares of UPS right now in my portfolio, and I'm just up just literally less than 1%. Okay, so not a lot, but I basically own that company in my portfolio. I have 10 shares of Lowe's, so I'm up just about 11, almost 11.5%. And Metronics, I've already shared that with you. And the other company, Williams-Sonoma, I do not own that company right now, but it seems really interesting, but I don't know, because of the cyclicality side of things, I don't know if I would be adding to my portfolio anytime soon. I hope you enjoyed the video. If you have, just give the videos a like, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.